What's up, ladies and gentlemen, investors in real estate investment trusts? This week we're going to talk about what happens if the gearing ratio, which is to me is sacrosanct for real estate investment trust for the protection of your wealth, investors, is tweaked by the SGX. Essentially, if you read the Business Times report last week, essentially there was some talk that essentially the SGX may be looking for some flexibility in actually increasing the gearing ratio. If indeed REITs are undergoing or is about to undertake AEI, or what we call Asset Enhancement Initiative. Would you agree on that? Well, let's find out. Well, in the Business Times report, it is highlighted that tweaking regulatory limits for S-REIT gearing seen as double-edged sword. And if you look further, ladies and gentlemen, I was quoted in the Business Times, and this is what I say, ladies and gentlemen. Gabriel Liap, a veteran REIT investor and chairman of GCP Global, believes that the cap on the aggregate leverage ratio for REITs remain very relevant for the protection of minority shareholders. The current high interest rate environment essentially forces and directs the REITs to be even more disciplined in their operational and M&A endeavors, he said. The leverage limits should not be changed or tweaked unnecessarily to accommodate commercial reasons, as REITs will then be perceived as less reliable as a steady income play and become more volatile instruments. So there you have it, ladies and gentlemen. This is what I was quoted in saying. There's a second part which I'll go into later, but let's go to the first part. Let's look at essentially this aspect where it has the higher interest rate environment essentially has forced and direct REITs to be even more disciplined. Now let's look at some examples of REITs that were not disciplined and essentially just continue to charge ahead with their acquisitions and boosting their gearing ratio in the process, as interest rates increased in the last 2 years. And how have their share price performed? How have shareholders of these REITs have benefited or suffered? The protection of your wealth in real estate investment trusts through GCP Global. Do join us for our various investment classes and courses. But one of the things that we have highlighted in our last class is, for example, those REITs that were not disciplined enough to undertake stringency in the gearing ratio. To us, that is a sacrosanct ratio. And let's look at this example. Take, for example, within the retail sector. Let's compare the Paragon REIT, which was formerly known as SPH REIT, versus Frasers Centrepoint Trust. Now, as you can see, ladies and gentlemen, this is a 5-year chart. You can see that the yellow line, which is actually Frasers Centrepoint Trust, has outperformed Paragon REIT for the last 5 years, right up to the beginning of 2022. And compared to the blue line, which is the Paragon REIT, so Paragon REIT has underperformed Frasers Centrepoint Trust. But ladies and gentlemen, if you read our last, a fortnight video, I've actually told you that and shared that I've sold off my shares, all of Frasers Centrepoint Trust, way before it actually started to go down, at above $3 in the beginning of 2020. And essentially, I have only started the buyback because certain things have changed. One is the fact that they are finally doing something right after doing so many things wrong. So what did they do wrong, ladies and gentlemen? You can see that the gearing ratio of Frasers Centrepoint Trust, 5 years ago in the beginning of 2019 was at 33.2%, higher than Paragon REIT at 26.8%. Then in the ensuing 4 years, 2019, 2020, 2021, 2022, what did Frasers Centrepoint Trust did? They went on a rampage. They bought Waterway Point, 33% increasing to 40%, paying an astronomical high price, which basically comes in at the low fours in terms of the cap ratios. You notice that essentially suburban malls, now the valuations is at a high 4%, which means that essentially in terms of capital value, Waterway Point would have already suffered in this aspect. Then they went in to buy the 10 assets under or rather all the retail assets under PGIM, for which the current CEO came from there. You see, essentially that boosted the gearing ratio of Frasers Centrepoint Trust substantially. And in our fortnight video, we showed you that essentially when the gearing went to the no 40% level, the share price suffered, and the share price suffered badly. Okay, so the next chart, ladies and gentlemen, shows you the what happened. So remember, the previous chart showed that for the 5 years up to the beginning of 2022, FCT outperformed Paragon REIT, or formerly SPH REIT. What happened since the beginning of 2022 is that the blue line now has superseded the orange line, meaning that Paragon REIT has become an outperformer compared to FCT. That's the price that FCT shareholders actually paid. And of course, if you're attending our GCP Global Investment classes quarterly, we already shared with you why we sold off, our substantial shareholding stake in the beginning of 2020 at above $3, and you would have benefited from that, because you can see that since 2022, the share price of FCT have severely underperformed Paragon REIT. In the process, you can see that one of the key things is that FCT gearing went up, right? Previously in 2019, right now up to 40.2% as of June of this year. Whereas compared to Paragon REIT, the gearing hardly moved. It's only 29.8%, because the management that my Miss Susan Tan, has been quite disciplined in looking at acquisitions. They have actually decided that essentially the weak market in Australia may not be too fertile ground, for further acquisitions. Move on to the next sector, ladies and gentlemen. Now, this is the industrial sector. So let's compare two particular stocks. One is Mapletree Logistics Trust, which ranks as the third largest stock in the IH REIT index, versus say ESR Logos REIT, which has recently combined with Logos. Now you can see, ladies and gentlemen, again dating all the way back to 2018, so for 5 years. The 5-year chart shows that MLP has outperformed ESR REIT. Okay, so well, that was because MLP's gearing ratio is 38.8%. ESR was already 41.9% at the beginning of 2021. But then again, ladies and gentlemen, some management, for example, ESR REIT led by the capable management of Mr. Adrian Chew. Yes, you can see from the photos that when we catch up with this REIT pretty often, I think we're very glad that the REIT CEO, Mr. Adrian Chew, took into consideration what we have actually tried to send the message through during our lunch and this is our drinks session just recently, and they've managed to actually start to sell off assets to bring the gearing ratio down. So what happened, ladies and gentlemen? Yes, this is the picture, and you can see that since the beginning of this year, the blue line, that's Mapletree Logistics Trust, went underneath the orange line, that is ESR Logos. Particularly so after it was announced that ESR REIT was going to sell off a couple of assets, raise 300 million to bring the gearing ratio down. And so the gearing ratio has come down for ESR to below 40% at 39.4%. Whereas for MLT, it's the other way around, ladies and gentlemen. You can see that despite terrible market conditions for the last 2 years, where interest rates actually spiked up from 0 to 0.25% to 5.5%, currently you can see that the MLT management still continue to take assets from the sponsor, that's the Mapletree Group, and inject into their REIT portfolio. So now, look, I'm not against acquisitions, but I'm always looking when REITs do make their acquisitions, they will always sing you a swan song. How good, how great, impact on DPU. Well, the numbers is one thing, but the track record, is also clearly that the REITs must deliver on this earnings in terms of the DPU, because hey, let's face it, man. I mean, those acquisitions that MLT did, a couple of years ago, from South Korean assets, Hong Kong assets to Vietnamese assets, to Malaysian assets. Do you and I know whether they have continued to underperform or overperform per what they guide you during the acquisition process? It's always aggregated in that line, when they say the NPI is down, explained because of lower rentals, occupancies, or is up because of certain other things. But in reality, you will not be able to follow closely and track whether those are the cases. And sometimes when we ask the questions of this among the REIT managers and among the head of investor relations, we are at a loss as to whether indeed this information is forthcoming, in terms of the operational performance. Of course, some REITs are rather transparent and do guide us clearly, for example, like ESR REIT, and that's why you can see that it's not surprising, therefore, that in just the beginning of the year, when they reduced their gearing ratio down to below 40%, which is the feedback we have been giving to the management, you can see that essentially the share price has outperformed even the good REIT, that's MLT. We're not saying that MLT is a bad REIT, it's just that they have continued to expand irrespective of how interest rates have moved. And this penalizes the share price, it penalizes the minority shareholders of MLT. For the REIT, it's like, hey, every acquisition you make 1% in terms of management fee. Every asset you sell, you get a 0.5%. Doesn't matter whether the asset actually makes or loses money. So who makes in the end if the share price have continued to decline in the last 2 years? You're right, the REIT manager, not the shareholders. So we at GCP Global tend to watch this very closely to help protect your wealth in real estate investment trusts. So of course, if you like us, do give us a subscribe button. Join us every week as we delve into the key aspects of investing and protecting your wealth through real estate investment trusts. Of course, do join us for our next class on 2nd of December, which is the last class of this year. Yes, we only hold our classes on a quarterly basis for the last 34 years. Now let's jump back to what I was quoted on Business Times last week. The second aspect of it, I mentioned that noting that the current period of rate hike is similar to that of the 70s. Yes, during the 70s, the Fed probably went on a quick rampage, pushing up real interest rates from as low as 6% to almost as high as 18% in a short period of time. And this is exactly what actually happened. And this brought many US REITs and European REITs listed at the time to their knees. Yap said, okay, loss of confidence can quickly give way to liquidity risks, which can in turn lead to insolvency. Exactly what we had predicted a couple of years back on EC World REIT, Daxing REIT, as well as Manulife REIT, ladies and gentlemen. Of course, we had attending our classes, we already told you to stay clear of these REITs long time ago. But the current situation may also present a chicken and egg scenario, as loosening leverage limit in certain circumstances will potentially allow some REIT managers a way out of the current challenges. Now, this is one thing that's contentious because in the first place, do you agree that the managers were the ones who actually put the REIT in such precarious position? Well, ask the management and assess the management of Manulife REIT, because essentially what's happening in the US office sector wasn't something that you can blame it on the pandemic, you can blame it on people not going back to the office. But if that was something that's happening leading to a trend, what should you do to your assets quickly? So as usual, ladies and gentlemen, for investors, we are always cognizant of changes in the REIT scenario. We need to make fast changes before the share price plunge, exactly as what you see from Life REIT. Could the managers have actually acted much faster? Well, it's argumentative. Well, of course, if you're sharp enough, like what we do as sagacious REIT investors, we always keep you posted and help you to actually undertake the actions to help you protect your wealth in real estate investment trust. So once again, enjoy this week's video. Give us a thumb up, and hopefully you can join us for our 2nd December plus and take advantage of the early bird special running till the end of this month. Adios, amigos.